view for the equity index for the United States. Let's take a look quickly on the foreign exchange. We can see that the dollar has actually rebounded. Now, last year, the dollar actually come off almost 10%. Okay, and that has been the overall direction of the dollar since the inauguration of Donald Trump for the second term. Okay, so we can see throughout the whole of last year, since January of last year, the dollar has been on one single track, which is down. Okay, but of late we can see there has been a bit of a bounce, starting with the first week of trading for 2026. Here we can see that this is the daily time frame. Overall sentiment suggests that the dollar direction has not changed, at least from the perspective of the daily time frame. It is still basically down, but we do have a bit of a bounce starting in the last quarter of 2025, resulting in the first week of this year. We beginning to see the dollar index is bouncing back up. So if this is what I think it is likely to unfold in a three-wave equality move, targeting anywhere between 102 to 103. Okay, this is based on the dollar index. And the dollar index is basically a basket of major US trading partners, principally the euros, the Canadian dollars, the Mexican pesos. These are the major ones, including, of course, the Japanese yens. Okay, so we can see that this is a basket of currency. So we can see that it is unfolding in a classical, looks to me to be a potential three-wave. And if that's the case, we will probably see a move beyond 100.36, which is the high that we saw here, which may extend all the way to 102 to 103 area. Okay, but there after that, we want to see how the dollar is going to perform, whether it is going to accelerate to the upside or whether it will start to topple back down. Because if the dominant trend is suggesting that the overall direction of the dollar is still weak, then there's a possibility after this three-wave bounce into 102 to 103 area, then there is a possibility it will come back down to take out 96.2. Okay, so that will be the ideal classic textbook pattern. Okay, but for now, at least in the short to medium term, we can see that the dollar may actually benefit from this technical rebound from the low of 96.2. Now, overall, we can see that the dollar index has a mirror image of the euro versus the dollar, because the largest component of the of the dollar index is actually make up predominantly of the euro, which is the currency used by the EU. So we can see that this is actually a mirror image. Now, here, while the dollar is likely to unfold in a three-wave rebound, so when the euro versus the dollar is a mirror image, we are likely to see a three-wave decline, okay, which is a mirror image of the dollar. And if that's the case, a three-wave pullback may actually target 113 to 115 in the euro versus the dollar. So you can see that this is, we are seeing the high in the euro at 119.19, somewhere in the last quarter of 2025. So this is unfolding in the pattern, which I think may result in eventual a move downwards to take out marginally the 114.70 that we saw last year. Okay, so this pattern is actually quite classic and is quite visible from both the dollar index and the euro versus the dollar. Now, this is the sterling. Now, sterling have a slightly different pattern. Okay, so here what we can be seeing is that the sterling has been trading within very much within a narrow band, which is a channel. So we can see overall it is elevated. Okay, there is no counter trend right now that is happening, although we do see a bit of the move from the high of 137.90. Okay, so here again possibly a three-wave move, but for now, by and large, I do expect at least a move into 128. Okay, so if this trend continues, okay, it may actually mimic what we are seeing in the euro versus the dollar, with a potential for further declines below 130. Okay, but 130 is not the end point. I think if this market do challenge the 130, it may actually go below to all the way to 128 even. Okay, but this will still make the sterling versus the dollar very much still on the positive bias. But overall, if you look at a higher time frame, such as the weekly or the monthly time frame, you will see that the dollar is actually very bullish. I am of the opinion that European currency is actually quite vulnerable for further decline over the longer term. So if you want to take the view of the principal currency, especially those in the European currencies, my bias is basically to look for opportunity to stay short. Okay, although whether you want to stay short is really up to yourself. Okay, but by and large, this is my opinion. I think there is a potential for the sterling to continue to edge lower below 130, perhaps going to 128. Okay. Here we have the dollar versus the yen. You can see that despite the Bank of Japan hiking interest rates, okay, the yen is still very weak. Normally, this will not be the case because if a central bank starts to hike interest rates, that currency will be stronger relative to the other currencies. But here, what we are seeing here, despite the Bank of Japan coming up and say that they are likely to continue to high interest rates, the sentiment is that this Japanese yen is still very weak. Okay, we are now bordering trying to test the 159. Okay, here we can see that in late 2024, we can see the high traded here is almost 159. Now where we are right now is challenging a 2024 high, and overall what it does mean is that further weakness in the yen, meaning to say on a corresponding basis, the dollar gains, okay, relative to the Japanese yen. There is always a risk of a intervention by the Bank of Japan. Okay, the previous high traded was 162, okay, in 2023, where the market came very, very close to 162, and it caused the Bank of Japan together with the Ministry of Finance to jointly intervene by selling dollar against the yen. So that caused the market to come down by 2,000 pips within a period of 3 to 4 weeks, which is a very large move. Okay, so as the dollar edge higher and the yen gets weaker relative to the dollar, we can see that the risk of central banks intervention is present. We need to say that it can happen at any time. Okay, the reason why the yen continues to be weakened is because at the same time where the Bank of Japan is hiking interest rate, it has been cancelled out by the new administration or the new government of uh, Sanai Takaichi. They are actually trying to raise money to actually stimulate the economy. So we know that Japan has the highest debt to GDP ratio anywhere in the G7. Okay, so for them to actually want to stimulate the economy, they need to issue even more Japanese government bonds. The Bank of Japan has already stated they are unlikely to buy more. Okay, they will continue to buy, but they won't be buying the same as what it has been doing over the last two decades. Okay, the biggest buyer of Japanese government bonds has been the Bank of Japan, to the tune that whereby they have contributed something like 52% of all purchase of JGB, which is the Japanese government bonds. And now, if they are going to stay away from the market, it means the market will have one major buyer missing from the market. So, who is going to be buying the Japanese government bonds? Very likely the banks, insurance company, and pension funds were also in no appetite because they have bought so much already. So they will have to find new ways to finance the new stimulus package. The only viable option right now is for the Japanese government to sell the massive holding of US treasuries. Okay, if they do that, they will be able to have dollars in their hand. And with that, they can actually use that to buy the Japanese government bonds. So that being the case, the yen cannot stay strong. Okay, so we do not know when they are able to raise the money to be able to buy the massive amount of JGBs. Okay, but the market believes that that is actually a negative for the currencies. So by and large, if the yen continue to weaken and if it zoom past 162 and the Bank of Japan did not intervene, there's a possibility it will go even higher. The target here is at 180 to the yen. Okay, 180 yen to the dollar. Sorry. Okay, so potential is there because the market is basically very bullish in favor of dollar gains against the yen. The dollar versus the Swiss franc. The dollar Swiss franc is actually quite tame. Now here we have dollar weakness against the Swiss franc, and it comes to a point whereby the Swiss National Bank doesn't want the Swiss franc to be stronger. So it has been moving within a very narrow band. Basically, it's between 78 cents to 81 cents. Okay. So the market has been doing that sideways consolidation for a long time already. Okay. We can see the whole effect since the middle of last year. It has gone into that consolidation sideways patterns. So further further movements in the dollar versus the Swiss franc will be quite subdued. Okay, it's going to be locked between 78 cents to 81 cents. So nothing to see here, in my opinion, because the Swiss National Bank does not want their currency to be too strong. Okay, and it will be such because when you look at investors, international investors, when they look at the dollar has lost 10% value last year. So definitely they don't want to put too much of money into the US dollars. But when you look around the global economy, there's no good options. So people will take a look at the Swiss franc being a very stable economy. So theoretically, the currency should remain stable. So that has attracted a lot of buying in the Swiss franc, which is not something that the Swiss national banks are celebrating. So they do not want a very strong Swiss franc. So that result in sideways movements in the dollar versus the Swiss. So I will not be looking to trade any thing in the dollar Swiss, at least not in the near term, unless this pattern is broken. Okay. Dollar Canadian is a little bit more active. You can see the dollar has been coming down relatively to the Canadian dollars. But over the last 2 weeks, okay, we can see that the dollar starting to rise, meaning to say the Canadian dollars has been weakening. Here we can see the dollar has been bouncing off 136, and it looks like it may continue to go higher. We can see from 136 low, the market actually closed at 139. So we are up almost 300 pips already in the dollar versus Canadian dollars. But overall, we can see that the overall trend is still in favor of dollar strength, not the Canadian dollar, the US dollar strength. What we are seeing from 130, 148 is basically a technical move, which suggests that we may still see lower prices in the dollar versus Canadian. We will target about 134, okay, which is this area over here. By and large, it could be a higher to sell kind of currencies, okay? So we will continue to watch this. Now, this is something I just added. Okay, I know there's a lot of Malaysian that comes into this session itself, and throughout the whole of last year, I do get periodically Malaysian asking me what's my view of dollar, Sing dollar versus the ringgit. So we can see that the ringgit has been gaining strength to strength at least for the whole of 2025, and this can be seen in the Sing versus the ringgit rate. And the Sing dollars is weakening. Okay, the low traded 2 weeks ago was $3.14, meaning to say you take $3.14 ringgit to exchange for $1 Singapore. So the trajectory suggests that we have not hit the bottom just yet. It's target about 3. So overall, if the market do go below 3.08, somewhere between $3, 3 ringgit to the dollar could be where it will stabilize. Okay, so further losses in the Sing dollars versus the ringgit is definitely something that is possible. Meaning to say the ringgit may continue to strengthen relative to the Sing dollars. So I hope this chart here can give you some idea as to whether the ringgit can continue to be strong relative to the Sing dollars.